All right, good morning, ACAs. It's nice to have us on the call. Um,
Good morning.
yeah, good morning. It's nice to have you. All right.
Hi, sir.
Yeah, can you hear me loudly?
Very clear, sir.
Okay, fantastic. Fantastic. All right, so we'll be looking at chapter 4. We'll be looking at chapter 4, which is business reorganization and capital reconstruction. And I hope we round up this in this class so that in the next class we'll be looking at our second pass question for this diet. Okay, so chapter 4 speaks to capital reorganization and business reorganization and capital reconstruction, and we'll be looking at these contents from the case study material. So we'll be looking at the purpose first, and we have just 3 units. 3 units speaking to capital reconstruction and reorganization. So the first thing we'll be looking at is the purpose. Then secondly, we'll be looking at corporate reconstructing, which is the first unit. Then secondly, we'll be looking at the need for financial reconstructing, which is the second unit. And lastly, we'll be looking at types of financial reconstructing, the third unit. Just 3 units for this session, and we are done. Okay, so what is the purpose of financial reconstruction? What's the purpose? Very important. So by the end of this chapter, we'll be able to explain corporate reconstruction. Why do a business or a company need restructuring? Then we'll explain the types of financial restructuring, and I often mix or synonymize reconstructing with reconstruction. So it sounds somehow the same, but then reconstructing is the right word. We'll also look at the types of financial reconstructing. Then we'll formulate and evaluate the scheme of arrangement. How do you rearrange a business when it's going down, when it's experiencing a dip, to bring it back up? That's generally what corporate restructuring speaks to. All right, so by way of unit 1, let's look at corporate restructuring. Corporate restructuring, by definition, speaks to giving a new structure, rebuilding something, or rearranging a business in simple form. So a significant change in a business model could also mean corporate reconstructing, restructuring management, injecting new blood. A financial structure could be changed to improve long-term profitability and shareholder value, looking at maybe the mix of equity and debt. So reconstructing generally looks at these areas pivotally, speaking to the financial or the business model, reconstructing or reinjecting new blood, changing management, changing the financial structure, speaking to equity and debt. And the goal is to improve long-term profitability and shareholder value. So that's generally the definition of reconstructing a business or corporate reconstructing. So like I said, the goal is to increase efficiency, profitability, competitiveness, and long-term survivals. Very important. So generally something has gone wrong and you need to restructure. When you talk of is to go back and do something again. And that's that preface, re. And that's what it means. So the goal is to increase efficiency, profitability, and competitiveness, and long-term survival. Very important. So what triggers corporate reconstructing? generally is loss of market share. Like I said initially, the company may be experiencing a dip in terms of volume, in terms of value, in terms of profit, in terms of revenue. So many parameters could trigger corporate reconstructing. And the loss of market share also reduced profit margins, speaking to gross profit, profit before interest and tax, profit after tax, net profit, could trigger, or the negativity of these profit margins or the reduction of them could trigger corporate reconstructing. Also, a weak brand. A brand may not be performing in the market. Also, the inability to retain talent, that's manpower, significant employees. Also, market or major market changes will trigger corporate reconstruction or reconstruction. This is very important. So the process that corporate reconstruction entails speaks to redesigning aspects of a corporate entity, the business or the financial structure. So you could redesign the business model and you could redesign the financial model also. That's the process. So what's the business strategy? You could redesign it. And what's the financial model or strategy? You could also redesign it in a corporate reconstruction scheme. Then the objectives are to increase shareholder value generally, avoid closing down the company or liquidation, bankruptcy. Then also identify significant problems, issues, or threats. Very key. So the objectives of corporate reconstructing speaks to increasing shareholder value generally, avoid liquidation or bankruptcy, and address significant problems that have bedeviled the business or threats that the business is facing. So we're speaking in the context of reorganization legally, reorganizing the ownership of the business, speaking to the shareholders, internal and external, or operational structures for profitability and better organization. That's the context from which corporate reconstruction or reconstructing looks at. A legend, Smith, in 2017 said, on successful reconstructing, we need to ask these vital questions. Why are we reconstructing? So the why speaks to the forces making change mandatory. That means something has gone wrong. So that force that made this change mandatory must be responded to, or else the business will go down. And that is why successful reconstruction is very, very imperative. Then Smith also said the what question, speaking to the necessary shift for success. And that's what successful reconstructing is all about. Like I said initially, the company is going down or experiencing a dip. Let's use the word failure. So what do we need to do? What do we need to restructure to move or experience that shift for success? And that is the what question. Another question Smith said is how. So it's not enough to know the why, it's not enough to know the what, but how to go about it. And that's the process to achieve the change, what to do, the actions to take. This is very important in reconstructing. Then what is next is building the future plan. So after knowing how to do it, you now do it. Build the future plan, take action, start the process by doing. And that speaks to two main parts of corporate reconstructing. And we're looking at operational reconstructing and financial reconstructing. So by way of looking at these two very important areas, the operational reconstructing talks about increasing economic viability of the business. So you are talking about the operations of the business, looking at how it's operated on the day-to-day basis. Now you're looking at short term. How do you increase the viability? You change operational activities around the day-to-day running of the business. So for example, mergers, you are merging a business with another one So one culture comes into another culture to influence it for success. So another example of operational reconstructing is selling maybe a part or a division of the business that is not doing properly in the group. You could sell a division that is not profitable to another division, or buy a division to your division that is more profitable, all in the quest to inject the positivity and the value that division is bringing to the group. Then also abandoning product lines. Any product that is not contributing positively to the product mix could be abandoned or killed. You kill a product. Then also cost cutting. You could close facilities, close major areas that have significant cost centers. So these are areas of operational restructuring that could facilitate that shareholder value and returning or necessitating that shift to positivity of the business. Then the section 2 speaks to financial restructuring, and we're talking about improving the firm's capital, its capital structure. Like I spoke about the mix between equity and debt. So in bankruptcy or in bankruptcy arrangement, this is often looked at as a scheme of arrangement or a plan of organization. So if the company is highly geared in the area of debt, or the company is lowly geared in the area of equity, it could be restructured. And this restructuring involves asset and liabilities. And that is essentially looking at debt to equity to match the cash flow needs. And the aim is to improve efficiency, growth, and maximize value for stakeholders or shareholders. And the reasons for this financial restructuring is significantly drop in sales, a slow economy, and other factors that could bedevil the business. And it may involve refinancing at all capital structure levels. So speaking to equity and debt, you could finance the business at all capital structure levels just to bring it back to where it's supposed to be. Very important. Okay, so often this capital restructuring or operational restructuring looks at the SFP. So the SFP structure is what drives this area of restructuring. Now, the SFP speaks to the paid up capital, which is our equity, how much has been paid up by shareholders. Then the paid up preference share capital. These are restrictive covenants. Then we also look at in the SFP various reserves, general reserves, capital reserves, retained earnings. Then you look at borrowings, debentures, long-term loans, bonds, overdrafts, commercial papers. You also look at short-term borrowings, trade payables, accrued expenses. So the company or companies should regularly review the structure of finances when needed for balance, and that speaks to the SFP. So in terms of operational restructuring around capital or financial restructuring, capital and the mix between equity and debt are two areas that must be looked at from the SFP. So take note of that. And balance, it's important. So depending on the needs and the uniqueness of the industry or the sector where that business is domiciled, you either know whether a company is highly geared or lowly geared and what necessary capital is needed to facilitate that restructuring. And that's why this slide speaks to balance. You need to balance it. If you need more equity, balance it. If you need more debt, balance it. The needs of the business should be addressed, and that is the goal. All right, so that speaks to Unit 1 on corporate restructuring or corporate reconstruction. Do we have any questions, contributions, or additions, observations to this first unit? Any questions, any additions? Okay, I believe it's clear enough. And also don't forget, feel free to interject if a thought strikes and maybe I shared something you need to be clear on. Please feel free to interject. Okay, so let's move to Unit 2. Let's move to Unit 2. Having looked at corporate reconstructing very significantly, Unit 2 now speaks to the need for financial restructuring. Financial restructuring. So there's need, like I've spoken about, the balance between equity and debt. So there's a need to strike that balance. And that is why the need for financial restructuring is what we are speaking to. So the funding of a business is what capital talks about. And that need is necessary to avoid any form of deficit in the capital mix of the business. So a company will be compelled to think and decide on financial restructuring when it's necessary to inject more working capital to meet market demands for the company's products or services. Working capital in the sense of your current assets meeting your current liabilities, and that has to do with in the short term, your day-to-day, month-to-month transactions, how you run the business in the interim, in the short run. So the need for financial restructuring or reconstruction or reorganization speaks to working capital needs, very essential for making the products and the services reach the market. Very key. So the company is unable to also, which is another need, is unable to also meet its current financial commitment is a reason why financial restructuring comes to play. Also, the company is unable to further obtain credit from its suppliers, maybe as a result of long-term or unpaid debt. So the need for financial restructuring comes to bear. Then the company is unable also to utilize its full production capacity due to working capital. Speaking to maybe a manufacturing company where you need raw materials to process into finished goods, and those materials are not available. So production maybe has halted as a result of suppliers not providing those raw materials due to debt unpaid. So the company needs to restructure to have this working capital to run in the interim or for day-to-day activities. So generally, that's the need for capital reconstructing or financial reconstructing. Very important. All right, it's a very short unit, and we'll need to be fast so that we can look at the third unit and shut down in this class. All right, so any question on looking at the need for financial restructuring? Any question? Okay, well, I believe our silence means we are getting the concept. Okay, that's good. All right, so we look at the third and the final unit. What are the types of financial restructuring? What are the types of financial restructuring? So there are three types of financial restructuring. We have the capital reorganization, we have capital reduction, then we have capital reconstruction. Capital reconstruction. Usually, reconstructing comes as a result of financial distress, either individually or combined. and that's often capital reduction and reconstruction together. So these schemes are necessary arrangements that help to reach out or bail out a company in distress. And the CAMA 2004 section 537 speaks to an arrangement that includes changes in rights and liabilities of members, including debenture holders, creditors, or company regulation. So that's generally what financial restructuring speaks to. And the types include capital reorganization, capital reduction, and capital reconstruction. So CAMA 2004 have made a provision for businesses that are going through distresses or businesses that will go through distress, and a structure, a roadmap is paved and provided to have something around for business to be able to navigate such circumstances when it happens. So CAMA 2004 section 537 provides this arrangement for businesses. Okay, so let's look at, by way of the first pivotal type of financial reconstructing, which is capital reorganization. So capital reorganization speaks to the cancellation or substitution of a class of shares with another one. And it's very essential because in reconstructing capital, the business needs to ensure that classes of shares are paid appropriately or are restructured appropriately. Very, very key. So we need to understand this concept very, very practically. Capital reorganization is essential because the cancellation and substitution of shares is key in understanding this concept. And generally, what does even capital reorganization, what does it mean? What does it mean? So before looking at the cancellation or substitution of the class and classes of shares with another, what does capital reorganization mean? So it looks at when a company changes the structure of its share capital or other long-term financing to improve its financial position or meet legal requirements or achieve strategic goals. So before looking at these classes of shares on the screen, capital reorganization involves reducing share capital. So generally, like the cancellation or substitution of a class or classes of shares with another, you understand that the need to cancel shares or reduce the nominal value to write off accumulated losses is what capital reorganization speaks to. Then another area very important is converting debt to equity. That's like, for example, swapping bonds for shares to reduce the interest burden. So where you have bonds that are interest bearing, you can swap them for shares to reduce that interest element, because normally bonds have the capital, the principal and the interest elements on them. Another area of capital reorganization is in the area of shares is consolidating or splitting shares. That is changing the number of shares and value of shares in issue. Then changing share classes. So for example, converting preference shares to ordinary shares. All those restrictive covenants that make it very stringent for company to meet their capital obligations could be reorganized to help reduce the burden for companies. This is very important. Okay, so an example of this swapping of shares, because it's necessary and very imperative that we understand the concept. An example of swapping of these shares could speak to a company with maybe heavy accumulated losses in terms of negative retained earnings. It may reduce its share capital. For example, it has a share capital of 1 naira each, which is 500 million in issue. That means the share capital is 500 million. And it can reduce that 500 million to 200 million, using 300 million to reduce or write off those past losses. So you see that this cleans up the balance sheet. Say, for example, there's 300 million accumulated losses, and it will make it easier to attract investors or declare dividends in future. Well, the burden of that 300 million, of course, is on the ordinary shareholders, but then it could benefit them in the long run by writing off those past losses. This is very, very key. So that's generally the concept of cancellation or substitution of a class or classes of shares with another. Also, capital reorganization could speak to the area of using change. Okay, yeah, please. AA, go ahead.
Okay, sir. Please, I just want to get something here. The capital reorganization is about more or less like replacing a class of shares with another, or cancellation. So I'm trying to get that cancellation thing, that in terms of what you explained just now. Is it that we are applying for instance, the losses to the share capital of the company? Hello, sir.
Yes, please. AA, come again. Let me catch your question.
Okay, so what I'm saying, you gave an illustration, so I was trying to understand. Is it that we want to just to have a better look of our books, we are now applying the losses to the share capital, or what? Because during the initial discussions we have had, we discussed about the fact that Karma frowns at capital reduction. So I'm trying to understand that with this illustration.
Okay, understood. Clear as water. Okay, so what I was saying in that illustration is that to reduce the burden of accumulated losses, of course, retained earnings, especially where it's negative, are called accumulated losses. So for a business to ameliorate that, they will need to, for example, reduce the share capital to write off these losses. So what we're saying is, in answering your question, shareholders or ordinary shareholders always bear the burden. If you look at areas of liquidation, bankruptcy, at the end of the day, the first people you pay are external providers of capital, the long-term debenture holders, restricted covenants like preference shares, and all those bond holders, all those external providers of capital. Most of their capital provision come with interests. So this example I gave of accumulated losses, a company will have a particular amount of share capital, and it could be agreed at an AGM by the major or general stakeholders or shareholders that, okay, let's cede some of these, our shares, to write off these losses, clean up our balance sheet so that we can attract more investors. Because a company or a balance sheet that has that kind of accumulated losses shows that the worth of the business is eroding. And that concept of ensuring that, okay, let's reduce the share capital and write off these losses with the share capital will help clean up the balance sheet. And that substitution of cancellation of shares with another is a concept I'm just using to say we want to cancel accumulated losses. Of course, an example will be, as we're going ahead, you see an example that speaks to substituting shares, especially for bonds or restrictive covenants and those areas of how to write them off. But at the end of the day, the burden is always borne by the ordinary shareholders. So that's generally examples I'm using to buttress the point on cancellation or substitution or even reduction of classes of shares with another. I hope that resonates a bit.
Yeah, it does resonate. I just want to get something now.
Yes,
because,
please.
the capital reorganization in relation to cancellation and substitution of a class of shares,
Yes.
are we now saying there are similarities between capital reorganization and capital reduction?
Yes, there are similarities, but the approach and the process of it may be different. Of course, they are similar. Yeah, I agree with you.
Okay.
Yes, they are similar. So we'll be looking at the approach of capital reduction when it comes to that area. All right, thank you for bringing that to the fore.
All right, thank you, sir.
Yeah, you're welcome. Okay, so having spoken to the cancellation or substitution of a class of shares or classes of shares with another, this can be used to change relative rights. That is the concept of capital reorganization now, can be used to change relative rights of different shareholder classes. For example, in a business reorganization. So the concept of changing relative rights of different shareholder classes speaks to the fact that businesses combine, businesses merge. And when they merge, if the essence is for reorganization or to enhance monopoly or oligopoly in that business space, so the change of rights of different shareholder classes is necessary, because a business that is performing more than another business and they want to merge cannot have the same par value. So one has to be more than another, and that is why the change of rights is necessary. So shareholders of businesses that are coming together to merge in form of business combination need to sit down and use their relative rights to classify the different shareholder classes in terms of reorganization. So they look at their profitability, their market value of the shares, and that classification or reorganization is enhanced. Very key in capital reorganization. Okay, so that speaks to capital reorganization. And the next one is capital reduction. So in the area of capital reduction, like AA opined, they seem to be similar. So the area of capital reduction speaks to reducing share capital and the par value to write off accumulated losses. So they are similar. Yes, I agree with AA. They are similar. So generally, what is even the concept of capital reduction? What is the concept of capital reduction? So having looked at the similarities, and from that example, because the example resonates more with capital reduction, like AA pointed out, and I agree with him, but then they are similar in the sense that capital reduction is a form. So I agree with his thought, is a form of capital reduction, capital reorganization. So capital reduction is a form of capital reorganization where a company decreases its issued share capital. Don't forget, we said capital reorganization is when a company changes the structure of its capital, share capital, or other long-term financing to improve its financial position. So capital reorganization speaks to when a company changes the structure of its share capital. Then capital reduction speaks to a form of reorganization when the company decreases. So reduction is specific on decreasing, and capital reorganization is specific or generalistic on changing. They might not be specific, but capital reduction is speaking to reducing the issued share capital. So that example I gave is maybe a typical example of capital reduction, and that is why AA interjected to get something clear. So in answering that question, yes, capital reduction is a form of capital reorganization. Yes, they have similarities, but capital reduction is specific. So the company reduces its or lowers its nominal value, the par value of shares, cancelling some shares or even buying them back. So it's often done to write off accumulated losses, like that example I gave, so the balance sheet looks healthier. Yes. So you can see that example is clear. And also, another area of capital reduction is to return surplus capital to shareholders. Of course, capital reduction, you have surplus and you return it to shareholders. So you could wonder how you are reducing capital and you are returning surplus capital to shareholders. Yes, it's very possible, because when some shareholders have their market value of their shares on the stock exchange very high, the return during a capital reduction scheme or event could necessitate that. And how is that possible? Because you are looking at capital reduction and you are saying you are returning surplus to shareholders. So it's possible because now some shareholders have a particular amount in value. And when those amounts are taken note of, the price in terms of cash payment speaks to the value, the nominal value of each shares. It cancels for some shares and pays shareholders the equivalent amount in cash. So, for example, if some shareholders have shares of 10 naira and is reduced to 7 naira, the 3 naira difference is paid back to shareholders. So they've reduced their nominal value, but that difference is paid back to shareholders. So another example I could say, or an area of capital reduction process, is share buyback. The company repurchases some of its own shares from shareholders at an agreed price. So the company will purchase it from shareholders and cancel those shares. So they've paid that surplus to shareholders. Very, very key. Then the last one is distribution of non-cash assets. Though this is less common. Distribution of non-cash assets. This sometimes looks at surplus assets like property, investments the company has embarked on. Sorry, I beg your pardon. Trying to connect something. Give me a second. All right, pardon me. I was trying to plug my charger. Okay, so I was speaking about the distribution of non-cash assets. Then I said it's less common, but sometimes speaks to surplus assets that could be sold under such capital reduction scheme and they looked at like property or investments are distributed instead of cash. So these three areas, cash payment, share buyback, distribution of cash, non-cash assets, are areas of capital reduction processes where it could happen. And a company will do this, thus reduce its capital to enhance more capital than it needs for growth or operations. It's either it wants to improve return on equity by reducing idle capital. And the company will do this as part of its reconstruction plan or reconstructing plan after selling a major business unit. So let's take an example of a manufacturing company that sold one of its plants for, let's say, 5 billion naira. And the company is not that 500 billion naira is not needed for operations. So the company returns 2 billion to shareholders via a capital reduction process. So it's possible they reduce each share nominal value and pay the difference in that cash with the proceeds from the sale of that plant. So that's a typical example of where a capital reduction for shareholders, ordinary shareholders, to write off also accumulated losses could transpire. Also, a capital reduction scheme speaks to reducing the nominal value of paid up capital. And it's necessitated by accumulated losses eroding the company value or significant asset value has declined, requiring revaluation. So these areas and these various examples we've given could speak to why capital reduction and the process of capital reduction clearly and graphically, and how they interlink or they are similar to capital reorganization. So most of these examples could happen under a capital reorganization or capital reduction scheme. So take note of that. AA, I hope as we've spoken to this capital reduction, you've gotten some thoughts and you're a bit clear on.
Yeah.
Okay.
Very clear.
All right. Fantastic. So the CAMA 2004 sections of 106 and 110 permits a company by its MEMAT to, or by at special resolution during their AGM, and also as approved by court. So the share capital includes the share premium, the capital reserve, and this MEMAT and this section permits a company to reduce or eliminate its liabilities on unpaid share capital. So the law allows that. It also allows the repayment of excess capital with or without reducing the liability. So the law also allows that based on CAMA 2004 and those specific subsections. It also allows the cancellation of lost or unrepresented capital with or without reducing the liability. So these are areas the law allows for businesses to navigate issues of financial restructuring. And also it's very important to take note that shareholders bear, okay, yes, please, AA, free, go ahead.
All right, sir. Sir, please, this I'm just trying to get, for instance, this excess capital thing. Illustratively, how can we look at it? So that, because I'm looking at this section as more or less like a part of requirement 2, right? So how can we relate it to the case study exam in terms of when we know that this is a situation of excess capital, and we just to have our proper recommendations and the likes?
Fantastic. So there's a question that has tested financial restructuring. There's one diet he tested it. Even though we've not looked at that diet, it was pre-November 2019 before the pre-sin started. Now, in answering that question, it may be good for us to look at that past question where he tested capital reorganization and this topic very graphically. But then, we may not look at it because it's not in our plan. We want to concentrate on more recent diet. It's a back diet, I think around that May 2015, 2016, 2017. Between those 3 years, he tested this area. So definitely it will come predominantly in requirement 2. So in looking at the boxes, if I will answer you, if a requirement comes on restructuring, now in looking at those boxes, our 8 boxes, you first perform your computation. Of course, there are computations, and I will recommend you go to the study text. I think there are 2 examples he provided, 2 full question examples. So you could navigate around them, look at how the computations were made. They are not complex computations, so to say. So you could go through them, then understand how to crunch the numbers. So once you've been able to crunch the numbers, you can now be able to speak around those 8 boxes. So we have the first to 6 boxes, speaking to the first one on data and information. So you could just give a general information on requirement 2, speaking to what the business has gone through and why the need for capital reconstruction, what brought the business to that point where it needed to restructure or reorganize. So just data and information without any numbers will suffice. So once you give 4 information on the reason in context of the case, the scenario, so you've picked 4 superior achievement points for the first box, data and information. Then the second, speaking to professional tools. Your professional tools now comes to the computation, what you've done in the computation of reducing capital, touching the assets, looking at the equity structure. Maybe you've reduced share capital, you've used it to write off debts and all that. So you can now explain using your professional tools, and that second header is now talking about maybe the analysis you performed in the exhibit. So don't forget to always cross-reference your computation with what you did in that professional tools. So you speak to what you reduced the capital initially, what the capital was, maybe for example 500 million, and accumulated losses in that business was about 300 million. So you use 300 million to offset the accumulated losses. So you explain that, reference the appendix, and every other complex computation. Once you are able to give 4 distinct points, you have your superior achievement. Then for the third area, analysis, testing your analytical skills. So you could just say, looking at the trends, this is what the business has faced over the 3 years. Capital was eroded, accumulated losses increased from so to so, depending on the scenario that was painted. So you look at key points or key areas and key figures in the balance sheet. For example, you see accumulated losses of 5 billion, 6 billion, that's key. You see debenture holders having debt and the interest so much. So those key areas should speak to what you need to address. So how you address them is your analytical skills the examiner is testing. You address them by saying, okay, for us to settle restricted covenants, preference shareholders, debenture holders, for us to work on the accumulated losses, the negative retained earnings, this is what we did. We reduced this capital by this, we sold this asset. So whatever it is, the analysis should be clear there in clear language, but cross-reference your appendix. So the professional tool speaks to what you used, the techniques you used, or the tools you used to reduce or perform your computations. Then the analysis speaks to how you did it. Then the fourth area is issues and options, then you say challenges and considerations. So challenges are negative, considerations, what to do, positive. So you could look at the case to speak to that. So what are the challenges? Why the reduction in capital? Then what to consider? What did you do to ameliorate or solve the problem? So 4 points explanations will suffice. Then the next one is ethical issues, which must be provided. What are the ethics? What happened? The directors circumnavigate controls? Were there issues with the financial statements padding? Was the business into unethical practices? So those are areas, and they must be pointed out in every case study exams. Then the next one is your evaluative skills and judgment. So you generally look at risk assessment in that area, positive and negative. Then you conclude and recommend. So a capital reconstruction scheme in the area of the exams, I will also suggest if you can go through that past question. I'll provide the past question particular diet for you. Just go through it so that you can have an idea of what could be tested. Yeah, he has not tested it in a long time. I think he tested it once. So thank you for bringing it to the fore. It can be a re-examinable area, but then with the pre-scene currently, we'll know or we'll have a clue to whether it's a financial reconstruction scheme that will be provided or any of this. So thank you for bringing that to the fore, and I hope I provided some thoughts to your question. If I didn't, please let me know.
You did, sir. Thank you very much.
All right. You're welcome, AA. Thank you for always engaging, and this is very, very encouraging. Okay, so please also remind me if I forget to provide that diet so that you can just look at it, even though it's not part of the 5 diets we are looking at in our past question and answer review. But then it's good you look at it, and because you raised a good question here. Yes, so please remind me. Thank you very much for bringing that on. Okay, so we're speaking to ways to carry it out, and we spoke to reducing or extinguishing the liability on unpaid share capital. And also we can repay excess capital with or without reducing liability. So these are ways we could carry out an effective capital reduction scheme that is approved by law. And don't forget, you can't carry out any reduction scheme that is not in CAMA. CAMA regulates company procedures, company operations, and company modus operandi. So it has to be within the ambits of the law. So we can cancel lost or unrepresented capital with or also without reducing liability. And the court also protects creditors, very important. And we'll be looking at that. You see, creditors come first in the ranking of either liquidation or bankruptcy. Creditors in terms of debenture holders, preference shareholders, external debt providers, not the internal now, who are the shareholders of the company. So the court provides them because they borrowed you money, that is borrowed funds. So you need to honor your covenant or your debt obligation. So they come first in the ranking of a business. So where a business has gone down and they need to settle debts, creditors come first. So the law allows the company to show a more realistic financial position and distribute future profits without covering past losses first. So you first honor creditors first before past losses are offsetted. So the simplest method is the proportionate way of reducing nominal value of outstanding ordinary shares. It's actually no change in the real shareholders' interest. It's just the nominal value. Their market value remains the same. But then reducing it to some extent if it's a crash or a liquidation situation. But in a capital reduction situation, except where the creditors demand it, it's not really necessary. But then the creditors always have this protection from shareholders, from the court, I beg your pardon. They have the protection from the court and from the law. They are always settled first. So their interest comes first before that of the shareholders. Okay, So the formulation principle speaks to the ordinary shareholders bear the greater loss, like I said. Then the fixed interest security holders should not be worse off than in the liquidation. So if a liquidation situation ensues, then creditors come first, then shareholders take the proceeds. So the preference shareholders also, looking at their loan stock, you can replace in a capital reduction scheme, you can replace preference shares with loan stock. That's to leverage on tax and some other areas and of their interest to be waded off. So preference shares have restrictive covenant and loan stocks are a bit lesser. The stringent obligation of loan stock, looking at debentures, bonds, than preference shares. So preference shares could also, the law allows them to be replaced with loan stock with also their agreement and consent in the scheme of capital reduction. We could also consider raising additional capital via right issue in our quest to settling capital issues in a reorganization scheme. So preliminary computations around total losses, determining them first, understand what are the total losses and what are the realizable value of the assets in the areas of liquidation. So we are looking at the areas where or situations where a company could continue as a going concern or could be in a liquidation position. So these computations around the discharge claims based on the liquidation priority, and the priority starts with, like I said, fixed charge creditors, speaks to also the liquidation cost must be settled. Then preference creditors must be settled also. Then floating charge holders, debenture holders, other bonds and other external creditors must be settled first. Then unsecured creditors also. We have contributories like shareholders, preference before ordinary, like we said. So this order, looking at external first before internal, is what the law allows. Then the update of CAMA 2020 removes irredeemable preference shares from that order. Formerly they were prioritized, but the irredeemable shares, only redeemable preference shares are allowed under CAMA 2020. But under CAMA 2004, irredeemable preference shares were allowed also. So the formulation of the scheme based on losses absorbed by contributors are based on these orders. So in summary of the scheme, there have to be a revised statement of financial position. A revised statement of financial position. In looking at the priorities and also the settlement by sale of the business and their assets to offset those liabilities. So, like AA opined, this question, ADEC Nigeria PLC, that's the first question in the study pack, shows how to calculate capital reduction needed to eliminate losses and write down assets. Like I said initially, there are two questions in the study pack. So I would suggest we crunch those numbers, go through them after this class, please practice them. So the first one is ADEC Nigeria PLC. It shows us how to calculate capital reduction needed to eliminate losses and also write down assets. All right, so I've had a safe landing. Let's stop here and go on break.